The Stanlib Resources Fund has almost 550 million rand in assets under management. Investments are made primarily in mining, metals, minerals, energy and commodity-related securities. For more on the sector and following in on our discussion with Stephen Menchie's is Stanlib's Kobus Nell, who joins us on the desk. And with the price of iron ore continuing to drop, analysts have questioned whether the resource supercycle has come to an end. That's our question to you. Oh. Has it? Is it all over? Are you out of a job?
It was just as easy as that. But I would say is I think the resources sector in general depend very much on what is the Chinese steel consumption number going to do over the next, call it 12, 18, 24 months. It's incredibly important that it remains strong, that it remains sort of above that 700 million ton per annum sort of figure, that you do bringing those higher cost Chinese supply, because that price, that higher cost Chinese supply will eventually give you the more of the super margin / super cycle maybe that many is betting on.
Kobus, we just heard Stephen, and we alluded to the fact that maybe this sort of calming down was partly because of what's happening in Europe and the States, and partly because there'd been a new leadership team in China that's taken over. What's your view? Are we just sort of winding down a little bit before we take off again, or what's your view on commodity prices in the long term, and especially the role that China's going to play?
Sure, and I think one thing that's clear now is the way the Chinese have sort of front-loaded their demand or their capital investment, and i.e. their demand. Obviously, when we came out of the global financial crisis, we heard about record iron ore imports. People was asking, what financial crisis are you guys talking about? And clearly, looking back now, you can see to the extent that they've actually brought that spending forward. And I think what one is basically seeing now is some normalization of demand. Now, obviously, what's been happening in Europe and the sort of the structural problem that's starting to impact, well, it has impacted global growth, and it's keep on sort of being a factor to reckon with for all these countries, includes the US, China, is a very important factor. In a way, it's almost made this correction sharper than I think what the Chinese has anticipated initially.
So just to get that right, are you saying in the build-up to the global financial crisis that China's been stockpiling materials?
Not just that, building, in terms of their physical investment in the country, i.e., creating capacity, floor space, building on infrastructure. A lot of these things one can see in terms of their stock levels and where they sit, that a lot of stock has been created over the last 2 years, sort of 09, 10 and a bit of 11. And then they started to sort of take their foot off the pedal as some of their own issues internally started to bite, like affordability on the housing side, that they managed to bring back to some extent now. But when you speak to the guys there, they will tell you, the 4 trillion yuan that they invested, that liquidity they pumped into the system, had consequences, and they're still busy dealing with that.
Now, you mentioned liquidity, and this was a big debate point with a number of resource analysts leading up to and after the first initial liquidity injections that we've seen across the system. We've just seen the next round. Doesn't that mean that that's inevitable, or it's inevitable that resources are going to go up?
Yeah, historically it's been very good. It's probably been one of the strongest drivers for commodity prices, subsequently to commodity companies. But in a way, one would look at the gold price and you would feel slightly disappointed in the way it's sort of moved subsequent to this open-ended liquidity.
You mean it hasn't gone through
created.
The roof? $2,500 an ounce.
It traded better, and you saw the market sort of kicking up for a couple of days, and then it's almost like there's a lot more skepticism from investors' perspective at the moment. It doesn't sort of just look at it and say there's liquidity, let's just rush in it and let's just buy it. Obviously we've seen a lot of short covering, I think, with this very sharp uptrade and a bit of a correction on the back of that, but in general it should be positive for commodity prices and mining companies, no question about it.
So just in terms, Kobus, of this ongoing debate, we've had this argument around how do you invest in gold? Do you invest in gold in the equities? You buy Harmony, Anglo Gold, or do you just sit in the gold ETF? And many fund managers we speak to, they say South African gold mines, they're aging, they're having to go further down. There's more safety issues. It's more expensive to do it. What's your view on the gold equities at this point?
Look, if you invest in a company, a mining company that's got a deteriorating grade, and the cost to take out a ton of ore out of the ground is increasing, it is fundamentally or internally, it is destroying value, all else equal, one would say.
Sure.
Now, if you get a stronger gold price, it basically helped those companies, but only to a point. And with them almost, continuing maybe with this negative downward structural margin trend, it basically is destroying some of this benefit of the higher gold price, and it doesn't actually, materialize this operational leverage which we hear about, why you should buy the equities. I think that's very important. So, like it is across the mining space at the moment, I think, when you're in an environment where margins are probably still contracting, where earnings are still, potentially going down and haven't sort of troughed yet, you got to look at quality here. You got to look at, when you invest in a company, you got to be sure that they're going to invest every cent wisely, and they got to actually uplift the profile of the company. If that's not the case, you're better off in the physical.
So you're saying then it's better just to hold the gold ETF? I mean, is that the position that you advocate?
Well, at the trend we've seen some of these companies, destroying value over the last couple of years. It's clear that physical gold has sort of been the outperformer on the back of that. And we hear a lot of.
The question is, would you perhaps be going into the ETF at these levels still, or you believe that gold has made its run? Although you're disappointed as to how hard it's run.
Yeah, I think the initial run-up that we've seen, and maybe a little bit of the rand strength, given the inclusion of South Africa now and the sort of the global bond, some of this has basically helped. Then you can say maybe the political instability we've seen over the last couple of weeks has done a lot of harm to the rand, and you can start talking around. But the rand, the gold price in rands has sort of traded up from about the 120s to 140 now. So it had a very good run up now. Maybe not to the extent that you would have thought if you start adding back the inflation that these companies has actually experienced over the last 18 months, 2 years. And I think that is where the key comes in, where you got to say, fundamentally, when you got this sort of this open-ended quantitative easing programs that's been announced, and you sit with these negative real yields in many places in the world, and money is so cheap in whatever currency depending on whatever currency you look at it. There's a lot of support for physical commodities, but you almost need those next catalysts to really to say, this is going to make, the gold price really shooting through maybe the psychological 2000 level or whatever that
Let's move away from the gold price and talk platinum. Obviously, it's been a beleaguered sector. I don't need to put all the vagaries of the industry on the table. Is it a good time to buy into platinum stocks?
And again, I think it is on a very selective basis. Just going out and say, Aquarius has fallen so much, or Lonmin, you're just paying so much per production ounce, its market cap is necessarily just something to close your eyes and buy it. If we are in a much slower demand environment and the market remains structurally oversupplied, you need ultimately stronger demand to bring your higher cost producers into play and to actually reward your better quality assets. Now, if you're going to sit with operators that can't get their that can't improve their relative cost curve position, and they don't really get in that position where they actually make positive free cash flow, then they're going to keep on destroying shareholders' value. And you may find a company that have done a rights issue 3 years ago and are coming to the market now again, that could come in 3 years' time again, So I think it's very important when you look at a sector that you got to buy the better quality assets, the operators, and the management teams.
The problem that you've alluded to, Kobus, there is that in the platinum industry, as I understand it, you have a very flat cost curve, which means that most of the players are very close in terms of costs to one another. So my question to you would be, so who do we go to first, the absolute lowest cost producer or the companies that can actually survive? Because there is a chance that much of the industry is underwater at the moment from the perspective of being able to reinvest in their mines. So a very tricky situation for the industry. Who are the lowest cost producers?
And I think it goes beyond just from a cost perspective. I think it's the miners also that can sort of produce the volume when the music really starts to play again. And we've seen companies like Impala, which have been more consistent investors throughout cycles. and some of the other companies has been more reactive in their capex profiles, like the likes of Anglo Platinum, maybe Lonmin you can throw in there, you know, and some of these others. And the problem is, you know, it is because it's about survival mode. You know, when you really go through a very tough environment.
Kobus, this is the problem, is that, you know, with the three big players that dominate platinum production, Lonmin, Implats and Amplats, is there not a gamesmanship going on here? Because they know that of those three, the first one to switch off the taps and start closing the unprofitable mines is immediately going to lose market share. The platinum price is probably going to react. So the guys that can stick it out at this point will be the winners of the future. Do you think that that's a negative, a very
100%.
corrosive effect?
And we've seen our Lonmin's balance sheet has deteriorated. We've seen our Anglo Platinum's balance sheet have deteriorated. Even in Impala's case, you know, they've obviously went through that long 6-week strike in the beginning of the year, which done a lot of harm to their balance sheet. But I mean, ultimately, it's from here on, you know, every month that passes by, which of these are burning the least amount of cash, you almost want to say, when it really gets bad?
And what would you be putting money into, Mr. Nell?
I would Impala, you know.
What are you putting money in?
Yeah,
So it's
I mean,
Impala.
in the fund at the moment, you know, we're running a slight overweight position on Impala. We're still fairly wary, as I mentioned, for the reasons for a company like Lonmin and maybe Amplats as well, given their restructuring that's on the cards, you know, and to what extent they will be able to restructure their mines, you know. We've seen the political unrest happening now, and whenever you start talking about restructuring and you want to do anything that's going to reduce the numbers, you got other complexities.